The question is, are there different kinds of construction financing? The answer is yes, there is. There's a one-time close and there's a two-time close. And it really comes down to this, the interest rate. What I mean by that is, when you lock in an interest rate, in other words, when you do the application, you sit down with me and we say, hey, let's lock in an interest rate, I have a clock ticking. I have to get that loan done within a period of time. It's generally 30 to 45 days. When you see rates quoted on the internet or anywhere else or by me, we're going to quote generally a 30-day lock. That means the loan has to be completed within 30 days. Well, that does not happen in construction. They're going to have to do a lot of processing and a lot of building before we start to finish. Well, so what do we do with that interest rate? You start out hoping the rate will be a certain thing, and what if it isn't? A one-time close comes along and says, I'll lock in that interest rate. You can just say, it's done. People love to hear that. They don't have to worry about it and it's finished. Let me tell you the backside though. The backside of the one-time close is, yes, your interest rate will be locked in, but it'll be locked in at a higher interest rate. It's called hedging. So what they do is they hedge the rate. When you hedge the rate, that means that you actually add to it just in case it goes up. So the rate might go up 0.5%, maybe even 3/4 from market rate, just in case the market changes quickly during construction. Now, they will have what's called a float down option. A float down option says, we're going to lock in your interest rate at a higher rate. If the market stays low, we'll float down the rate one time before construction. It's a pretty good security instrument. Because the other side is, on a two-time close, they say, well, let's just do the construction loan separate and the long-term loan, then we'll see how it goes, and let's just watch it. You don't have any hedging. You can just simply watch it yourself, have the loan officer with you and say, how are rates, what are they doing? If you think about it, there's a 3/4% spread of hedging that's going on. You can take that risk on yourself, or you can put it on the lender. That's your call. I personally like the two-time close. Why? Because I like the control. I watch it every day. I don't want to have that hedging there. I'd love to show you more details about you and your risk aversion or ability to take risk, and that's really what it comes down to. They both work to get you completed in the home. It's up to you. Call me, we'll talk details.